So suppose you have X dollars and you have two choices available for how you can use it. The first of these is to put the money in a CD or certificate of deposit with a 3% interest rate. And of course, this money would be held onto a bank for the duration of the deposit. In fact, one of the key features of a CD is that when you make the deposit for it, you agree with the bank that you won't withdraw the money before a specified amount of time has taken place, which for the problem I will call Y years. You still can withdraw the money early before Y years has passed, but you'll be charged an early withdrawal fee if you choose to do so. The other option available to you is to loan the money to some person who says they want to use it to purchase a new car. They also say that they'll pay you back in the same time frame as the bank, so Y years, and they'll pay you back at a greater than 3% interest rate. At first glance, it might seem preferable to give the loan to the person. After all, they have exactly the same time frame, and you get more interest and thus more money in total if you make the loan to the person. Furthermore, there's this puzzle, which is that if you give your money to the bank, through its role as a financial intermediary, may then use exactly the money you gave to them or an equivalent amount and loan it to the very same person. And so the question arises, if the money ends up in the same hands, what difference can it possibly make to you whether it goes through the bank as an intermediary or not? In fact, you probably prefer the person because, again, there's a higher interest rate and you get to take the profit that if you had deposited the money with the bank, they would have made when they made the loan to the same person. There are three primary reasons why it is you still might prefer the bank nonetheless. So the first of these is related to the concept of liquidity. And liquidity has a couple of important usages within economics. So the first of these is meant to describe a relationship between a given type of asset, so for example, a stock or a bond, the price at which you may sell that asset, and the amount of money that you will receive, because there's often a time delay between when a sale is made and when you actually receive funds, when the transaction is completed. That's not the context that's relevant here, but it's still related to time. In this context, liquidity is simply a measure of how readily available some fund attributable to you can be accessed. And so we might say that a savings account, any money you have in a savings account, would be more liquid than the CD. Because the savings account doesn't have any restrictions on it, the CD has some restrictions on it, namely the Y years, or alternatively, the withdrawal fee should you choose to withdraw it early. But there's an important sense in which the CD is still more liquid than the loan that you've given to this person. And this is going to be related to the second concept that can help explain why you might prefer the bank. So I'll go ahead and write that, which is information. So the reason you might want your money before Y years is passed is you can't make perfect predictions about the future. Some unforeseen circumstance, such as an accident, may arise that requires you to access money that you thought you wouldn't need and hope to gain the benefits of a higher interest rate through a CD. With a bank, you have that option of withdrawing it early, even if it's at the cost of the withdrawal fee. With a person, if you can't make the prediction about when this, by definition, unforeseen circumstance will rise, then you almost certainly can't make an effective prediction about whether this person will actually have enough money to pay you back at an early time. And so the money that you've given to the bank is more readily accessible than the money you've given to this person. This is also related to the second concept, as mentioned before, which is information. To understand it, we need to construct a comparison between you and the bank. So there's two key differences related to information. The first is that straightforwardly, the bank just has more of it. They have access to all kinds of information, whether it be the credit history, mortgage history, the amount of savings that a given loan applicant has, how much assets they have, say in the form of gold, stocks, and so forth. All of that information the bank has access to and can use to make an evaluation of whether a given loan applicant is likely to default and fail to pay them back. You likely have either a very small subset of that information or just none of it at all when you're considering whether to make a loan to this person. And so you have less info. So that goes to the bank. But the bank also, even if you had access to all the same information, say because this person is just really honest and gave you access to all of it and it's accurate. Even so, you wouldn't likely be able to make effective use of that information, even supposing you had it. Whereas the bank could probably make at least more effective predictions than you about whether this person would default. And there's some obvious reasons for this. So, in one sense, you face the same incentives. So, both of you want to ensure that anyone you give money out to as a loan, you'll be paid back by them. But the bank is an institution, which has some important benefits. Because, first of all, they can hire many experts, whether they're actuaries, statisticians, fiduciaries, and so forth, that are able to effectively have an understanding of what can impact a person's ability to pay back a loan, and also utilize all kinds of modern tools that have been developed for making such predictions, various statistical models, as an example. And so, even if you were such an expert, you're competing against an entire institution as an individual, and you're kind of already falling behind in the comparison there. But furthermore, the bank has significantly more experience making loans, and that experience can provide them information that they can then utilize and incorporate in their predictions and methodologies for evaluating loan candidates. And so that's another advantage. They have been around for decades, if not over a century, depending on the bank. And they have made many, many more loans than you likely will, even in the totality of your lifetime. And so all of these are reasons as well that the bank can better utilize information independent of how much they have access to. So that would be another reason that you might instead that you might prefer the bank. In particular, it's important to notice that it does make a difference then whether you loan the money directly to the person or whether that person is screened by the bank, because one of you will probably do a better job of it. And you care because if you do a poor job of making predictions, then you may end up with actually less money, or it may take a longer period of time for them to pay you back, say if they ask for an extension on the loan. Neither of those cases, you might have some reason to prefer the bank. Now, the final reason that you could potentially prefer the bank is going to be related to the role of government. One of the more puzzling aspects of all of this is the fact that I've just said, oh, well, you probably can't make effective predictions about whether this person will go bankrupt. So, how is it possible that I can effectively determine whether the bank will go bankrupt or not, since they are likely more complex than this individual person? And the answer is that, well, you don't need one s- because of the function that the government has provided. So, following the beginning of the Great Depression in 1929, the Banking Act of 1933 was passed. And one of its functions was to create the FDIC, or the Federal Deposit Insurance Corporation. Specifically, what the FDIC will do is provide deposit insurance in the name. And what that means for you is that should a bank end up going bankrupt, you will still be able to get your money back because the FDIC, with the full backing of the United States government, will provide you those funds even if the FDIC, even if the bank cannot, up to $250,000. And this covers not only savings and checkings accounts, but also includes CDs. And so is of relevance to evaluating the differences. By contrast, the FDIC doesn't provide those same guarantees if your money is stashed away with some random person you decided should receive a loan. And so even if the bank is really bad at predictions, goes bankrupt because lots of people fail to pay them back, which has happened in the past, you're still likely to have access to your money and thus exposed to less risk as compared to if you loan it to the person.